Well, we saw a nice lift in the dividends we received across the companies we invest in, but particularly out of the resource space. Rio, BHP now have very strong balance sheets. Management is more focused now on where they're investing their capital, which we are strongly supportive of, and we're now seeing more of their profits come back to shareholders as dividends. We certainly want to see the companies reinvest where they've got opportunities that are sound. We're wary about the large acquisitions, particularly if they're not counter-cyclical. So strong dividend growth out of the resources, I think that'll continue for some period, so that's attractive to us. We did build up our position in Macquarie Bank, which is a nice dividend producer. We did add a bit to Sydney Airport in weakness. Again, they produce a nice yield. So that was some of the key areas where we had profit growth from. Final dividend has been maintained at 14 cents per share, fully franked. The franking component of the dividend is obviously very important for our shareholders. We're seeing a lot of discussion in the press about potential changes that going forward. We certainly have strong views that we'd like the current regime to continue. We think the franking system we had at the moment is a very good one. The management expense ratio is 0.14% with no performance fees. That's a very attractive cost to shareholders, and it makes it a very attractive investment product in the market when you look at the fees that other fund managers charge. Yeah, well, the market's been very strong, and particularly we're seeing strength in the mid and small cap part of the market. I think a lot of money's flowing in that part of the sector. There's some fantastic companies there, but we're seeing PEs now, the likes of which I've never seen in my career. Some businesses we're seeing multiples 40, 50, 60, 70 times. So we're cautious about that part of the market. We'd actually like to see some weakness there so we can add to those good quality companies. The mid and small cap resource stocks have been very strong over the last 3 years, but certainly the last 12 months, up 45% out of that part of the sector. We're not big players there. We see that as being a very cyclical part of the market. We're really focused on the large resources, the businesses that have world-class long life deposits, the Rios, BHPs. Those companies pay great dividends throughout the cycle, so that's where we're focused on that part of the market. So when those mid and small cap resources run hard, we can underperform a little bit, but that's to be expected. But we know over the long term, staying with the big players is the place to be for us.